Hello, I'm Travis Chatwin, here to discuss what we at Summerlin Asset Management do for you, the investor. Summerlin Asset Management LLC, or SAM as we know it, is a diversified real estate investment and management company. SAM's expertise is the purchase, resale, and servicing of both performing and non-performing real estate notes secured by a deed of trust. SAM has been in operation for over 4 years, acquiring various residential mortgage assets. We provide secure trust deed investments that are recorded by a licensed title company, documented on the public record in the county recorder's office with title insurance for our first position lien. Investing in bank-owned real estate notes. Our entity will purchase a pool of sub-performing and non-performing real estate notes secured by a first trust deed. The purchase price will be negotiated between SAM and the financial institution that is holding the note. The main objective is to acquire the first lien position note at a price that is significantly lower than the current market value of the subject property. Another objective is to make the trust deed a performing note that can be sold for 2 to 3 times of the purchase price. The relationships that we have established with banks throughout the United States give SAM investors the opportunity to invest in distressed or charged-off real estate notes that are secured to properties across the country. We are able to purchase these mortgages at a large discount, creating an investment that is very secure and offers an excellent rate of return. For example, we recently purchased a performing note on a condo in Miami. The current BPO is $450,000 and the first trust deed was $364,000 with a 7.5% interest rate fixed. We purchased the first for $250,000 and will receive nearly $30,000 in annual interest income. This transaction also created $86,000 in equity increase for our portfolio. We can choose to enjoy monthly income or help the owner refinance and cash out. We usually hold the loan for 5 to 6 months, then sell it for a premium or refinance the borrower. Workout and exit strategies. We have designed a streamlined process for our acquisitions, asset management, and homeownership retention programs. After we acquire the first trust deed, we offer borrowers several options so borrowers can retain their homes and successfully continue down the path of home ownership. Starting with number 1, short payoff. One of the most equitable options we have for a borrower is short payoff. In this instance, we provide a 6-month option where a borrower can pay off their mortgage at a price below market value. This happens by way of a family member putting up the cash, private money financing, or using 401k proceeds, if available, to pay off the home loan. Here's an example of that. You have an unpaid balance of $300,000, a home value of $200,000, and a purchase price that we did of $120,000. In this case, we would offer the borrower a payoff of $180,000. In addition, we will write off the remaining debt, relieve the borrower from the difference. Since SAM is still profitable, we do not 1099 the borrower for the difference, thus creating no tax liability for the borrower. Number 2, short sale. The most common of all workouts. We will work with the borrower to list their home. During the short sale period, we allow the borrower to live in the home with no mortgage payments. By keeping the borrower in the home, it ensures SAM that the house is being properly maintained while the short sale process continues. If the borrower has a second lien, however, SAM will work diligently with the subordinate lien holder to reduce their balance and be paid through escrow upon closing. And upon closing, SAM will provide the borrower with financial assistance to relocate in a smooth and efficient time frame. Number 3, loan modification or forbearance agreement. In this case, the borrower fell behind for a variety of reasons: loss of income, health issues, career change, etc. The borrower has expressed a desire to stay in the home and demonstrated the financial ability to sustain the current mortgage payment. We create a forbearance agreement that will take the total amount of payments and divide them by a sum of 12. We add 1/12 to the regular monthly payment. This will immediately help the borrower to get back on track, increase our cash-on-cash return, and reestablish the borrower as a seasoned performer. In the event that the borrower lapses on the forbearance payment, we reserve the right to initiate foreclosure. Number 4, cash for keys, deed in lieu of foreclosure. This is an instance where the borrower is emotionally disconnected with the home and is living in the home. We create an opportunity where the borrower is released from all personal liability on the obligation and walk away with enough cash to relocate and establish a new life. We offer them an aggressive cash incentive to sign over the deed to the home. The scenario exists if the home only has first position lien that we purchased, and the balance of the loan is higher than the value of the home. After we come to a formal agreement in writing, we perform a thorough inspection of the home to identify potential problems. Our contract states within our discovery process we identify problematic situations such as roof leak. We have the right to reduce our cash offer to the current owner. Our team encourages the homeowner to treat this as a business decision. Number 5, principal balance reduction. In this scenario, the balance of the borrower's loan is 175% or greater than the value of his home. In this case, the borrower wants to keep their home. However, the borrower realizes they will never recoup the negative equity that they are paying down. Sam will structure a 12-month program to write down the balance of the borrower loan in exchange for 12 months of uninterrupted, on-time payments. Here's an example of how that works. Unpaid balance of $300,000, let's say. Home value $200,000. Purchase price of the note for us $120,000. Monthly principal and interest payment $1896. We give the borrower a $5,000 per month balance reduction at the end of 12 months, assuming the borrower has made 12 on-time payments. The end result is our portfolio enjoys a cash-on-cash return of 18.9% on $120,000 investment, while the borrower has the benefit of reducing the balance of the loan by $60,000 by month 12. This gives the borrower hope that their house will become an asset in the near future. In addition, Sam now has the ability to sell a 12-month seasoned performing loan upwards of 70% of the value of the home. In conclusion, our return on investment for 12 months is 35.62%. Number 6, foreclosure. Foreclosure is a last resort for Sam. If our asset managers are not able to complete either of the above, we'll deploy our legal department and recoup the asset via foreclosure. This process can take anywhere from 120 to 360 days. In doing so, we immediately recoup funds and do not insure the sale of the process. In the event that the asset reverts back to Sam, our team of realtors will list and dispose of the asset as an REO. Sam will perform an asset search of any borrower. If other assets exist, we will explore the deficiency rights against the borrower. This is an unlikely scenario, but one that still exists. Questions or comments? Please feel free to contact me at beachandsunhomes.com or give me a call at 619-752-4663. Don't forget to check out investinfirsttrustdeeds.com. Have a great day.